my latest video on how to use the Trading 212 app to invest in the stock market, I had a comment from someone asking what the term PE ratio meant. Now, this comment didn't come out of the blue. I did actually refer to the PE ratio very briefly in the video when I was talking about Amazon stock and how it could be a useful metric to assess the value of a stock. The price to earnings ratio. I will talk about why PE ratios are super important shortly, but it occurred to me that there's so much investing related jargon out there that we need to sift through to make good investing decisions as investors. It didn't really matter how easy the Trading 212 app was to use. If we weren't understanding and applying the different metrics to review stocks and make sure they were good quality buys, then using an investing app like Trading 212 might be a little disadvantageous. Like I've said in many videos before, there are literally no guarantees when it comes to the stock market. But we do know that those that invest wisely and stick to a long-term plan have the potential to earn some strong rewards over time. I think it's relatively easy to understand the long-term part. You just buy and hold your assets and hold for 5, 10, 20 years and hopefully reap the rewards later. But the wisely part to me means being able to make informed decisions. And I think part of that means understanding some of the jargon and metrics that are used to compare and analyse stock. So in saying that, I'm starting a mini-series here on my channel that will kind of bubble away in the background and look at some of the terminology that you'll likely see cropping up on investing platforms like Trading 212 or wherever else you buy or carry out your stock analysis. So hopefully that will be interesting to some beginner or even seasoned investors. Let me know in the comments below if there's any jargon or stock metrics that you'd like me to address in future videos for the series. And we'll get started with the obscure PE ratio. You've seen it on every investment and stock analysis platform there is, and it's probably one of the most fundamental metrics to consider before you invest in a stock. The PE ratio, or price to earnings ratio, is a valuation metric that gives investors a quick look at how the market is currently valuing a company. How much are investors willing to pay for a stock relative to the company's earnings? In other words, is the market currently placing a high or low price on that stock when you compare it to how much money or profit that company is generating? You can then tell if that company's stock price is currently trading at fair value. Is it undervalued or is it overvalued? So by comparing the current price of a stock to its profits, you get an idea of the premium you're paying for exposure to that company's profits. Generally speaking, and I say generally because it's not always the case, and I'll talk about why towards the end of the video, but generally speaking, stocks with a lower PE ratio, say of 10, would suggest the stock is currently cheap and possibly undervalued, whereas stock with a higher PE ratio, say of 50 plus, suggests the stock is currently expensive and maybe overvalued. Now, you can calculate the PE ratio yourself by dividing the price per share by the earnings per share, which gives you a multiple number, so something like 10 times or 50 times. But you shouldn't really need to calculate this yourself because you can usually find the PE ratio for a company wherever you find your stock information. I personally use quite a few sources, including Yahoo Finance, Google Finance, Seeking Alpha, etc. And I'll include links to these below in the description. But essentially, you should be able to find this data quite easily without breaking out a calculator. So how does this all work in practice then? If we look at the stock information for the well-known soft drinks company Coca-Cola, for example, you can divide the current share price per share by the earnings per share, which gives you a PE ratio of nearly 27. So this is telling us that the market is currently valuing the shares of Coca-Cola at 27 times the amount of their yearly profit. So if you were to buy shares in Coca-Cola, you would be paying 27 times the amount they generate in profit for the year. This ratio also tells us that it would take 27 years at the current price and profit levels for Coca-Cola to make enough money to pay back all of its shareholders. If we look at the PE ratio for PepsiCo, which is currently 38.65, PepsiCo is trading at nearly 39 times the company's annual profit. So if you bought PepsiCo shares, you'd be paying $39 for every £1 of PepsiCo's profits or earnings. But if you purchased Coca-Cola shares, you'd only be paying $27 for every $1 of Coca-Cola's earnings. So if you were looking to invest in a soft drinks company, you might decide to invest in Coca-Cola over PepsiCo because you're paying less for the exact same amount of earnings. So by comparing the PE ratios for these two companies, the market is telling us that Coca-Cola might offer better value at the moment for our money than PepsiCo, because you get a bigger piece of the profit pie with every £1 or $1 you invest. Coca-Cola might offer better value, not because it has a lower share price than PepsiCo's, that's neither here nor there, but because it has a lower PE ratio. Like I mentioned earlier, the lower the PE ratio, the less that you as an investor pays per dollar or per pound of a company's earnings. So rather than comparing the price per share of two companies, which really doesn't tell us much at all, the PE ratio provides us with a common measurement so we can compare apples to apples instead of apples to dogs. But we need to remember that a company's PE ratio is really only looking at a snapshot in time. It's generated using the current share price and past earnings. And as investors, we can't forget that past or even current performance is not a guaranteed indicator of future results. While the PE ratio is a great way to assess value, it isn't the only measure we should be using when evaluating the value of a stock. For instance, some stocks may have a low PE ratio because they have limited potential for growth. Just because a company has a low PE ratio and seems undervalued, it doesn't mean that the stock is good value. If company profits stay the same from year to year, it will take a longer time to make a return on your investment. Or even worse, profits could drop, meaning that you never make the return you wanted in the time frame you required. On the flip side, a higher PE ratio doesn't automatically mean the stock is overvalued and a bad buy. PepsiCo's PE ratio might seem expensive now, given it would take you a longer time to earn back the money you invested when you compare it to its rival Coca-Cola. But if PepsiCo's profits grow from year to year because it has a more diverse product offering than Coca-Cola, then all of a sudden the payback timeline gets shorter and shorter and the PE ratio starts to look a lot less expensive. In this case, a higher PE ratio could indicate greater growth opportunities are on the horizon, so the current price of PepsiCo may be worth the investment. Another thing to be aware of is that profits can sometimes be distorted by one-off earnings or losses, meaning that the current PE ratio could be a bit off and not representative of the ongoing or operating profit of a company, which is essentially the earnings generated from a company's core business. Sometimes a company might not have a PE ratio at all, or in some cases, it might show as a negative multiple. This is because the company has no earnings or it's losing money. If there's no profit, there's no earnings per share, and this is the denominator that we need to calculate the PE ratio in the first place, as I showed you in the formula earlier. You should also be aware that the PE ratio is only really useful when comparing companies in similar markets and similar industries, because different industries will have different trends when it comes to PE ratios. So it wouldn't make much sense to compare Coca-Cola's PE ratio with Microsoft, for example. This is because the expectation and growth rates within the beverage sector and the technology sector are completely different. Coca-Cola might see more consistent and steady profits at a lower growth rate, whereas Microsoft's profits might be expected to grow much faster, but have the potential for a lot more volatility. It would make much more sense to compare Microsoft's PE ratio to a different tech company like Apple to get a better idea of the valuation for each. Even stock indices like the FTSE 100 have PE ratios, so not only are you able to compare a stock's valuation to other companies in the same industry group, you can also compare it to a benchmark like the FTSE 100 or the S&P 500. PE ratio is a great flexible tool because it can help us as investors to determine the market value of stocks as compared to the company's earnings, so we can see if it's a value or growth stock. But remember that PE ratio, whilst really important, isn't everything. And there are definitely other factors that we should consider when evaluating stocks that we want to buy. I'll talk more about what these are in future videos for this Investing Explained series. So please do hit the like button and subscribe if you found this useful, and stay tuned for more.